Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, January 25th, 2019. In this video, I want to take a look at the bigger picture for the stock market. We'll just look at a couple of long-term charts, um, probably maybe two time frames. We'll look at just the monthly and weeklies. We'll stick with that. Before we get into the market, we'll look at SPY here in a second, or the S&P 500. Intel reported last night. Intel, as most you know, is the largest, by far the largest chip stock out there, industry leader. Yada, yada, yada. The rest of the chip sector is up today, although Intel is down. This is an older chart. We'll get to Intel in a second. But I wanted to talk on that because it really ties into the bigger picture. Again, this is one of the market leading stocks. I don't know where it is right now, but for a while it's been about the sixth largest component of the NASDAQ 100. So it's definitely still up there in the top 10. Now, what I wanted to highlight is where the stock is probably going. And so this was from a post on the site back on, actually a video, I'm sorry, and I'll post a link to that video if you want it, May 30th, 2018. So just before Intel topped, did a video on the semiconductor sector and covering this one and the others, stating that they looked to be they were poised for a significant bear market, one of the best shorting ops at the time. And from there, they did drop. That was right around the time that semis peaked. They dropped about, I think the sector as a whole, 25% at least. And they by far led the broad market. They started their bear market back last summer, early summer, and the stock market didn't follow, as you guys know, until last beginning of last fall. So this was a scenario laid out, and again, the charts were very clear. And I was pretty emphatic on that and calling for a move down here, about a 24% drop. I said at least, I actually said at bare minimum, I'm looking for a 24 to 32% drop. And these were my targets, 24%, expecting a bounce from there. That's the first target. And then I still expect a move down. Now this is what we've had so far. In fact, let me pull the chart up. You can see the levels back then, 42.59 and 38.27. Now let's go to an updated chart of Intel, and you can see almost to the penny, close enough for government work when you're calling, stock that it's an all-time high. Everybody wanted to be long, nobody wanted to short, and the stock fell down to same targets I had, the same chart. 42.59, the low was 42.36. So again, close enough for government work. That 24% drop was hit. And we did, as expected, as I often say, the initial tag of support, when it hasn't been visited in a while, the initial tag will usually produce a reaction. And so the question is the reaction over or not? I think so. I think the end's very close, and I'm going to get to that in a second with the stock market as well. We can't say I don't have any solid sell signals. We got a pretty bearish candle being put in today, but for the most part, the stock's been trading since it had the reaction off that level. It's been trading mostly sideways. But again, keep in mind, this is the industry leader. This stock is down 6.5% today. The market's rallying on, just more, I'm sorry to say BS from the Fed, but Fed's just again backing off their plans to taper down the balance sheet as much as they initially said that they would, and so the market's rallying on that. I'm sure that's not anything that the big banks didn't know about. It's just I'm sure the retail public's buying today on what is probably old news for the crony banking system and all the big banks that put those people in power. So the next drop will be again down here, I believe, before all is said and done. And this is where I'll really be interested in, tucking some Intel away if the charts confirm at the time. But that's my target. And so from where we're at today, we'll go from where we were yesterday or earlier this week. That's about another 24% drop. Now we got knocked down on earnings today, so there's not as much meat on the bone. And again, this isn't. I'm not going to the daily or 60-minute charts right now. That's where I usually go to hone down entries and exits. Although I do think the semis are going down, I just wanted to highlight this one and again paint a bigger picture. Before we get off the chart, you can see the PPO is still down here below the zero line in bearish territory. Indicators are pointing lower. And so again, I just view this as a bear market rally with more downside to come. Okay, now let's take a look at the broad market. We know the semis are an important sector, and as I said in that video, again on that, what was it, May 30th, whatever I was just covering, um, I had said at the time that the semis lead tech. Tech is the market. Tech, is the largest component of, not of course of NASDAQ 100. It's about 60%, but it's also by far the largest component of the S&P 500. And as I said in that video, the semis are the canary in the coal mine for the tech sector, and so they corrected, started a correction, and even had a bear market before the rest of the market did, and I expect they will also lead the next leg down, most likely. Now, this is a long-term chart. We're going all the way back to the 80s here. So you can see the last three bull and bear market. Well, I should say last three bull markets and the last two bear markets. This one we'll see if it's completed. Before we get there, let's jump back again. Let's look at another post. The same chart. This one was back on. Let's see. I posted this on May 31st, and that the SPY long-term charts we were on watch for a potential sell signal. And again, I'll post a link in this video. I will post on the front page, right side of the chart. I'll keep this public contents, general market analysis, so you can come in there into the site and then get a link to this post as well as that semiconductor post. But I went through a couple things here. I took the time to really hone in on this chart. So what you're looking at here, and again, we're going to get to this chart. We'll look at the updated chart, but I kept it pretty simple. There are three things I'm looking at on this chart other than the price of the SPY, the S&P 500. We're looking at trend lines, looking for trend line breaks, which of course are your sell signals. I often talk about divergences, things like that. Divergences are not sell signals, they're indication of a trend change, but these are some sell signals that I use. The Ppo histogram. Down below you have a Ppo. Now, for those not familiar, it's like a MACD, but you try this on your own chart. Put up a MACD on a 30-year or 20-plus year chart of the SPY, it's not going to look right. And that's where a Ppo will shine on a security that has, you're either charting a very long time period or anything with large price fluctuations from the low in price up to the high in price. And that's why you'll see on my long-term charts, I'll always use a Ppo over a MACD. So what I've done is circled the bearish crossovers, and that's what a histogram will do for you. When you put up a histogram on a Ppo or MACD, it's just a visual representation of when the two lines cross. So when it goes from green down to red, crosses below the zero line, you have crossover down below on the Ppo and the Ppo signal line. And as I said in that post, I don't use any one single trigger for a buy or sell signal, especially long-term stuff, but rather a combination. And the more buy or sell signals you have in close proximity, the higher the probability that that buy or sell signal will play out. And again, if we're looking at a long-term monthly chart, that's as long as I go. I don't even mess around with the yearly charts. You can look at quarterly charts, yearly. This is as long as I go. This is the 401k money stuff. I had mentioned last summer moving out into a 100% cash position into 401ks, 403h or 403h plan, money purchase plan, the type of plans that you cannot buy index ETFs or just mutual funds like a typical 401k. You can either go into U.S. stock funds, international stock funds, small mid caps, bonds, and that's about it. Or cash. So cash is where you hide out, and as of today, I mentioned last Friday taking it down. I had gone in, scaled in, as I mentioned. I scaled out before the market fell. Got out a little early, and that's fine. Sit in money market, you get a little something. I mentioned scaling in mid-December and going back in long, and started to scale out a couple weeks ago. Last Friday took it down. I think I said about a 20% net long exposure with most of the money in cash, some into treasuries. I started just transferring back into treasuries last week, actually. Did it today again. So I'm now down to probably a 10 to 15% equity exposure, with the remainder, the bulk of it, in money market, and a pretty decent size now in treasuries. I just want to mention that. And Again, I'm not going off topic. This is your 401k chart. This is your long-term investor chart. I put out all kinds of analysis. If you're, in the trading room, you're going to see 1-minute charts from me, 2-minute charts, 5-minute charts. YouTube channel on the front page of the site, right side of the chart. Typically 60-minute charts, daily time frame. Those are your swing trading time frames. But these are your trend trading when you're trying to catch the major trends. And as you can see, you have the trend lines, which are, if there was only one thing to trade off of, that would be it. If I could only use one thing, would be to look at trend lines if they're well defined for your buy and sell signals. But of course, we have other indicators, and I'm going to get to a few more here in a second in addition to these. So I showed where the Ppo crossover, and it was, again, talked about it and saying that we were waiting the next sell signal would come on a bearish cross. We already had a trend line break on this trend line off the 2015 lows. Trend line break there, but a back test, and a sell signal was pending on the PPO cross. Okay, fast forward to today. This is a live chart. Again, that one was back from last summer. You can see what happened. We back tested, and then you did have a brief cross there. And again, you have to wait for a monthly close. But it proved to be a whipsaw signal. However, even if you took it, basically, and you moved into cash, you moved out of your equity positions in your 401k, you gave back minimum. We're talking a few percentage points there, hardly anything. We had a couple more months where the market went up, not very impulsively. And then right after that, we had 1, 2, 3. Now we have 4 consecutive signals, and we're well below the line. See, whipsaw signals, sometimes you get them. You'll have a little tiny whipsaw signal. The thing triggers back. And again, there's other indicators that you use. I don't use this as a buy and sell. Every time this thing flips to red or green, I go all long or all short. It's not like that. I'll scale in, scale out. I'll look at it, and I'll look at other factors. But there it is. So I just wanted to make mention that these are really your, telling us, as I've been saying, that the primary trend, all my long-term trend indicators are still bearish right now. Just about all of them, I should say. But there it is. And as I said in that last video, it has captured, looking at these histograms, they're telling you can just visually see bull and bear markets. So again, if you're a long-term trader, this was a bull market. This is when you should have been long. This is years. We're talking years here. These aren't just quick signals. This was a bear market. There was a big drop back there, the Asian contagion, or at least close to a bear market. I wasn't 20%. I think it was very close. And then that's the dot-com bubble at the top right there. And then we had a vicious bear market. And again, you can just see what a great job. And this is, again, one of many indicators that you use. None are perfect. This was a bear market, by the way, by many accounts, most indexes. The SPY just barely avoided the 20% threshold drop, just as it did this time around as well. It was only 19.97, I believe, in the SPY. Although just like back then, a lot of sectors, many sectors went into bear markets. Many indexes did fall more than 20%, including the NASDAQ 100. So I just want to make mention that's not a whipsaw signal. And we had a lot of people consider this a bear market back there as well. That drop, by the way, was over 20%. That was a 22% drop in SPY. It's not talked about as being a bear market, but it was, and it was pretty quick. I guess that's why they didn't consider it such. But I measured it from high to low, it was 22%. This was a period I was talking about where the SPY had just missed that designation, but many small caps, mid caps, they dropped over 20. Many sectors did. So again, call it a whipsaw if you want, but it was certainly was almost over a year and a half of sideways to lower price action. So it would have been nice to get out of there and not have spun your wheels. You would have made at least something in a money market fund. So that's all I'm getting at. So now, where am I wrong? Where will this be proven wrong? Because any trend indicator can trigger whipsaw signals. I'll tell you. In that previous post that I was showing you back from May, this 20-month EMA has done a bang up, phenomenal job, in my opinion, about as good as any one single moving average can do to define bull and bear markets. So again, there's a scrubbing factor. You want to see both these trigger, not just the PPO histogram, but you want to see this. So you can see this was the longest bull market in history right here. This is the one that's about to be overtaken if we do make new highs soon. And you can see I did a pretty lousy job there of hitting the line, but I think you can make it out. Hold on one second. Okay, there, I changed it to a brighter color, and that's it. So you can see about as good as a job can be done. And it's a monthly chart. These are monthly candles. So all that matters, not these intramonth little pops down below. Those are candlestick tails right there. They don't matter. All that matters when you're trading on a monthly time frame is a monthly close. So then right here, you entered bear market territory when you cross down below with a monthly close. And look how good a job it did just saying, stay short. The trend is bearish. Keep your 401k money out of the market. And, it's not going to nail the bottom. We can do that with other things. We can hone in on the weekly and daily charts, and I can guarantee you we'll get a quicker buy signal than waiting for this. But with that being said, if you want to just sit back, not chance trying to get in too early, wait for this. And then you can see once we got above, boom, just did a phenomenal job. This was the 2003 to 07, late 07 bull market. Every single weekly candle, not a single close below once we went to a bullish sell signal, and then boom, there's your first red candle. Came in, looks like probably in early January, as I suspect. The highs were in October of 2007. Broke down, back tested and failed. Didn't close above it. And that was another great shorting op there on the back test, because remember, support once broken becomes resistance, and it kept you out of the worst bear market that we've had in many, many years. And then you can see trading was a little choppy off the lows. There were a couple whipsaws here and here. Again, you can call them that, but as I said before, this was a 22% drop, so you might not want to really refer to that as a whipsaw signal technically. And then you can see once trading normalized and, after all the volatility coming off the lows, look at those pullbacks to that level. You can buy it. And again, this was also bear market, considered by many a bear market, at least a nasty sideways market for a year and a half. So call those, I think it's fine that it told you to get out, as I said earlier. And then this is the trend line that I'm focused on right now. There's a primary trend line off the 09 lows, plus this one that comes off the early 15 lows. And that's where we had a breakdown, a back test, and that's where the market started rolling over. And you can see last month, this is December's candle right here, a big solid red close. And right now, what are we doing? We're back testing. So we have about a week left to go in January. It doesn't matter how high this candle goes, it's where it closes the end of this month. And I'll say this too. If we close a hair, let's just say right now we're a little bit above that 20 EMA. If we close that far above it, for all intents and purposes, that's a back test. You want to see it regain solidly. So if you're wondering, where do I change my longer term outlook, that this may have just been a correction, a great buying opportunity on the road to new highs, well, this will certainly factor into that. It may not be, again, a all or none type thing for me to, okay, I'm going to go back 100% long if we have a solid monthly close above here, but it will start to change things a little bit. Now, I also have this trend line here off the 2009 lows. This is our primary bull market uptrend line. And you can see that we may come up to back test that as well. So we have, as I've been saying and focusing on the daily charts, pretty much just a confluence of resistance above. We have these key moving average, we have the trend line, that trend line, we have a lot of price resistance as well. So again, I feel very confident when I say the easy money has been made on this rally off the lows of December 24th. Doesn't mean we can't go any higher, but I think it'll be a kind of a battle, if you will, a struggle for the markets to move up. I don't think they'll continue at the ascent or the rate that they've moved up over the last month or so. Okay, and let's look at two other indicators as well. I'm going to put up the ROC12 and the RSI here. So we've already looked at the PPO histogram. We're going to pin that, get rid of that, and we just looked at the PPO. So those were the first two we looked at. And you can see here the RSI and the weekly chart. We had, strong, very clear negative divergence off the high, just like we did on the PPO. Last time we had divergence on the weekly chart, and we also on the ROC12. You can see these divergences, and that tends to mark your bull market tops. Again, we're looking at a monthly chart, so this isn't exact timing type stuff, but it does paint the bigger picture. And so if you're a armchair investor, your 401k money, that kind of stuff, where you can't trade actively even if you wanted to because of the restrictions in there and all that, but you might want to tactically or at least strategically position your funds to avoid a 30, 40, 50% drop in the next bear market, that's where I think that's what this is helping us do. And so again, worst case scenario, the way I look at it, is if I'm wrong, if this proves to be a whipsaw signal, if this proves to be, a great buying op, well, I've already milked most of the run up, and so I'm fine getting out. Worst case, I don't lose a penny. I make what 2% or whatever the money market fund's paying for the next month or so is almost now. I'm not fully back into cash, but close to it now, and probably will be on any more upside. Still have a plan where if we get a nice pullback to my target soon, I may go back in. I may not. I'll let you know about that. Might have to see. And I can tell you this: I would not be going back in 100% equities on a 5-6% pullback if we get it here soon. That I wouldn't do. There's too much that says that this is quite likely everything that we've seen here at the beginning of a new bear market, and this is the first bear market rally. And on that, if you recall, I had quite a few questions coming, heading into the December lows. A lot of members on the site saying, "Hey, Randy, if you've made a great case as a bear market, why don't I just put all my money into QQQ short, a QID or SQQQ or one of the inverse ETFs and throw away the key?" And I was emphatic about that. And now you've seen it. This is exactly what a bear market rally looks like. What we had off the December 24 lows, and anybody that would have shorted, especially if you didn't short the highs in the market, if you nail the highs or close to it and you're profitable, that's one thing. Great. Set your stops, appropriately and let it ride. However, if you shorted on the way down, and not too far off the December lows, you're now underwater, and you can continue to get underwater. That's the thing. No matter how great the charts look, how strong my convictions are, anything is possible, and that's what stops are for. So my point being that we can navigate a bear market successfully by looking at the longer term charts, anything at least a daily time frame out to the weekly. Maybe the monthlies might give us some clues, and then we can swing. Or here, let's show you on another bear market, and then we can successfully time, if you're so inclined, the micro rips and dips. This was a big rally here in late 2008 before the final thrust down. But again, so to each their own. Some people might just want to get short or get out into cash and stay into cash until a clear buy signal comes. Others might want to game these rips of 20+%, these bear market rallies in a bear market. Game them on the long side, or if you're swing trading short positions down, maybe cover those index shorts when it looks like the chance for a bear market rally is very high. At least get out. You don't have to go against the trend. There are people that don't like trading against trends, and I get that too. So that's what this chart can help you do, is just stick with the primary trend until there's a lot of evidence, as I'm showing you here. And so back to what I was just talking about earlier, here's another one of my favorite long-term trend indicators, is the ROC 12, rate of change 12. Sometimes I'll toggle this to an ROC 13. You'll see that, and play around with each index. But you can see it does a pretty bang-up job. Again, this was technically a bear market, or a drop of about 22%. So you can call those whipsaws or not. But other than that, even if you call that a whipsaw, you cannot deny how well the track record is on this. We're saying be long, the trend is bullish, the primary trend. Be short or out of the market, the trend is bearish. Pretty simple stuff. So, and this is the longest bull market in history. Again, this was considered by many to be a bear market, the very least a deer market or a sideways market for a year and a half. So, you might not want to call that a whipsaw signal, but now we have two solid red bars, and both of these bars back to back are combined deeper than any of these whipsaw signals that we've seen in the past. So to me, this isn't the only one. I just showed you the PPO histogram as well on the monthly. This is much more indicative of this early stage, or this. In fact, these are even bigger, these two red bars, than the first two bear markets had on the ROC 12. So that's something else to consider. Okay, and before we leave the monthly, about to wrap this up, we'll go look at the weekly real quick. Let's just have some fun with fibs, I call it. All right, so fibs are Fibonacci retracements. If you don't know what those are, just a quick Google search will fill you in. So Fibonacci retracement here, I'm going to just do it on the three bull markets that this chart spans. Again, going back to the late 80s. However, the bull market officially began. This is the longest one in history, back in 1990. You had a bear market before there. It was a drop of 22 or whatever it was. So here's the start of the bull market. There's the high. This is again the dot-com bubble. For those of you that were around, if not, I'm sure you heard of it. And so I put a fib up measuring the entire bull run, and you can see it's just amazing how often these work and how well they work. These are the most common. The ones I like to use. There are different Fibonacci, key Fibonacci levels, but I like the 38.2%, 50%, and 61.8 retracement levels, which are typical retracements of a counter trend move. So, we've been in a secular bull market in equities. That's one way to look at it. And these are cyclical bull and cyclical bear markets within the secular bull. So the secular is the bigger trend, and again, then you have cyclical bull and bear markets within that. And they're vicious. I mean, that last one we had was 55% drop in the S&P 500. So, but again, it's just, like I said, amazing. You can see perfectly 61.8 Fibonacci retracement. You can see the dotted line coming across here. Hopefully you can pick that up in the video. That's what capped that last bear market and marked the bottom. Now let's just move forward to the next one. I'm going to put the lines at the highs there. And again, that was back in December of 07. Move this up to the bottom right here where this bull market started back in 03. Was it 03, 02? Looks like I'm hitting the low there, and I think it was 03. There it is. Yep. No, 02. Okay, stand corrected. And you can see now that one actually made a full retrace and then some. So again, this was an unusually vicious bear market, but over 100% retrace. And where I'm going with this is I'm going to try to put in perspective, because I know a lot of people just don't believe, they can't fathom when I give them price targets, like when, a few months back, like Intel, I just showed you, 24% drop, and I think there's more coming. Amazon, I called for the same drop that we just had back when Amazon was at all-time highs, when it was hitting, became the second $1 trillion company, and you can see what's already happened. So don't underestimate and don't ever fall to the illusion that the markets are going to go up forever, and the bear markets, the Fed won't let them happen again, whether it's their easy money policies or anything else. So again, 100% retracement. Now let's just go to this market here. And this I find pretty impressive. So we go down to the lows in 2009, up to the highs. We'll assume that the highs that we had last fall were the highs. And you can see this lines up almost perfectly with my price target. I think we're going to come back and visit those highs. I see it's a very, very nice support level. It was key resistance. That's where we broke out of, call it about 213, give or take. And you can see that comes in the 38.2 Fibonacci retracements just below that. And I could certainly see this market going down to test. You can see we had a lot of big corrections. See those big monthly candles back here? That's about 108 or 180, 181 on SPY. That would be my next target, even if I didn't have these fibs up. But you can see there's a Fibonacci line, the 50% fib right there. Again, call it coincidence. I've done this enough to tell you it's not coincidence how these key fib levels tend to line up very well with important support and resistance. And keep in mind, I didn't even zero these out exactly. That's one thing on TC2000 you can't do. They don't snap to the, I think you can have a setting where you can snap it to, but I'm just trying to line these up manually. And then finally would be this level here. Now this is a very important technical level, and I know this is heresy right now for a lot of bulls out there to think this, the SPY could drop all the way down to 156. But if we're about to embark on a secular bear market in the U.S. stock market, it's been a long time. We've been in a secular bull market for a long time. There's a good shot we come down here. And keep in mind, that would only be I'm not going to call it run-of-the-mill, but within the typical retracement levels. Again, that would be a 61.8 retracement to come in and test the 2000 high and that 2008 high or 2009 high. And it comes in, so it's price support, very key reaction highs, as well as a perfect alignment again of this 61.8 Fibonacci retracement. Remember, this bull retraced over 100%. And what did I say that first one did? Go back there. I should have remembered. Was it? Let's see here. That was, yeah, 61.8. So that would be a comparable move down to this previous bear market, and it would be less as far as a percentage retracement than the last bear market to see us come all the way down here. What would that mean from high to low? Just to put in percentage terms, that would be a bear market of, I had it there. Let's grab the top of the candle, make sure I add the top. That would be a bear market of about 46%. Well within the norms of bear markets. Less than the last one, more than some, on the higher end. And I can tell you, and I've said this before, I don't think it'll be a repeat of '08. Just my thoughts based on a lot of fundamental variables and everything else. I think it'll be a longer, more drawn out bear market. I think there'll be plenty of opportunities to trade long and short swing trade trends within. And it could take, I would suspect, at least a couple years to get there, and possibly more than 2 years, if we do get down there. And I'm open to all possibilities, but I just want to highlight that. And maybe you take it on face value. Maybe you think it's, again, heresy to even think that the market could drop that much. But if it does, just try to put in perspective and quantify it, not in perspective. Try to quantify what that would mean to your 401k if you wrote out a 6 or so percent drop over the next 3 or 4 years. So, all right, we'll wrap it up here. And this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.